All right. Good morning, everybody. We have economic data on the table today that will go to the heart of the Fed. It's not their preferred gauge, but it connects to it. Hong Kong down 0.25%. The Dow is basically flat. Then we get the S&P, Japan, the NASDAQ, and running out is small caps leading the way. So we want to keep an eye on short covering rallies and the typical small cap plays. There was a report that came out yesterday about small caps. And as usual, that sort of shining a light like that on inflows or outflows and generate more attention, which just generates more flows. So I'd be careful on, how much that sticks. Still, it's a good start in seeing small caps leading the way. Just keep in mind on a rally day for the ES, the NASDAQ, you don't want a rally led by small caps because it doesn't stick. So we got core PPI. We got some Fed speakers chipping teeth. The beige book today. We've got over in Europe, European Central Bank, Lane is going to also be talking later tonight. Data out of Japan. There's been a lot of talk about the German 10-year. So going into Wednesday, keep your eye on that. And then, of course, we get into CPI tomorrow as well. I'm surprised at this point that the market hasn't started going sideways as we wait for this data, right? If you've heard me for a couple of years now, there's times where we talk about a market going sideways while we wait on data. And it's often a part of the morning briefing where I say, I don't think we're going to go anywhere. I think we're going to hold the line, go sideways, and wait on some economic event. But we're not seeing that at this point. Maybe it was because PPI came first this time. It doesn't always. And we could see through the later part of the day a consolidation and then that sort of trading activity that makes us believe we're going to sit and wait for CPI. It's possible. But so far, we're not seeing that kind of hurry up and wait mode at this point. Yeah, there was also some talk about bringing in the tariffs a little bit at a time, this gradual increase in trade tariffs. While he was running, a lot of people said, well, he's got a history of throwing out flamboyant and, argumentative statements just as a starting point, like a negotiation tactic, that he's not really going to do this. He's just trying to pressure these different countries and that he wouldn't really do the tariffs. That was the prevailing wisdom. And some of the moves that we've seen in the last, I don't know, 36, 48 hours has been because he doubled down and said, oh no, I'm definitely putting on all of these tariffs that I've been talking about. And the market really didn't like that, like a reality check. So now there's this report saying that, yeah, okay, yeah, maybe he's going to do these tariffs, but it'll likely happen a little bit at a time, not all at once. The market just needed an excuse and they got one. So, even a delusional excuse is better than no excuse at all, I suppose. We still have the 10-year holding highs. We still have the dollar up around 109, so it's still holding these highs. And in the big picture, that needs to change. Now, I was going through some work on developing some insight on home builders and companies that may benefit from rebuilding in Cali, if they can even do that, with all the regulations and everything. There's even an argument about whether that'll even happen. But the 10-year is going to come into play here as well. There's a lot to that. But at this point, we need the 10-year and we need the dollar to calm down. And throughout 2025, I don't think that dollar is going to calm down anytime soon. So sure, getting back below 108, that line way down here, has been the goal for a long time. But I think we're going to have to readjust our swag levels when it comes to the dollar and even our approach to how the dollar is impacting the markets. We'll kind of circle back on that later in another morning briefing. More importantly, I think leaving the dollar out of it at the moment, focusing on the 10-year, the 30-year, the 2-year, and that might be the way to go. So we tried to run last night. We hit the 3-week moving average. We don't use moving averages for support and resistance or tradable opportunities, that sort of thing. It's not the idea. It's just having them on the screen so we understand what we hit or where there could have been liquidity. 59.11 is a cog line, and 59.12 is where the 3-week moving average is at. So maybe we hit a cog line, maybe we hit a moving average, but it's also likely just where there was liquidity for whatever reason. But that is the line in the sand that we have to get through. Talked about the 20-week quite a bit yesterday. That's the green line here, the 20-week moving average. So we were underneath it. We got back above it. Kind of the line in the sand on the weekly that I think we really need to keep. Otherwise, we have this November 4th candle, this really big week here. And the low of this candle would be our next line in the sand. And that would form on a weekly this really big inverse cup. Then we have to figure out what we're going to do underneath this. If we break it, then we've got a double bottom, which is a bear trap. We'd need to overshoot this low and go lower than that low so that we can get bears to believe we're actually going down so we can trap them. Otherwise, if we match that low and we begin to bounce, that gives us an inverse cup and handle. So then we would expect a handle into like 58.92 area and a continued move to the downside. This pullback so far is less than 6%. The one in August was 10.5, and in April, basically 7. Another one back here at 11, and then 9. So if we've got 7, 9, 11, this is coming up a little short. I wouldn't be surprised if we can get a little bit lower. 5 to 7 generally is the average. I mean, really, we don't need to focus exclusively on the ES on these pullbacks to look at the history of the market and say that 5 to 7% is like the market average for a pullback. Start focusing on SPY, SPX, ES, then you can get more granular, more specific. I'm on a weekly, although honestly, I don't think that matters too much if we're still just measuring the depth of the pullback. But if this is the end of the pullback and we're starting to run back up, then it's pretty shallow compared to some of these others. And time will tell at this point. We don't have enough information to know if this pullback is done or not. But that is a really nice looking trend. Lower highs, lower lows. We've got the 10 and the 20 spread out really well. I'm on a daily now at this point. We're underneath the 50-period moving average. We got a 10-20 cross, and we have the 20 under the 50. So this is straight up a downtrend. Now you can talk about looking for the rebound or buying the dip all you want, but I mean, look in any economic or trading textbook, and this is the very definition of trend. Just happens to be going down. So all of that needs to change, and we would have to get above 60.50 and get through this high and make new highs higher than that to have, at the bare minimum, a more complex topping pattern or the beginning of a reversal, because after setting that high, we would need a higher low. So we'd have to come up here and break that, then fall back down and set a pivot higher than this pivot, higher than this low, right? It's all stages, not done in a single shot. We're still inside of this candle. It's January 10, and the midpoint of this candle is a little bit of our concern. 59.02, it's basically 5,900. We need to get above this and stay above it. Then we got to get through the 10-day and get through the high of that candle, 59.60, to challenge the 20-day, the 50-day, and begin working our way back up again. But there's another half back once we get through that one. 59.56. Really, hold on, we got to adjust that a little bit. 59.38. Now that half back lines up with that 10-day. So it's just the 10-day, basically. But right now, January 10, the midpoint of that is the candle of concern. That's the trouble point that we've got to get through, and that's basically 5,900. And so far, we rejected that 59.11, the 5,900. We're already well underneath it. And we got to focus now on reciprocation. So what we get on one side of VWAP, we generally get on the other side of VWAP. Typically, what we do is just measure the distance in one direction and then plot that to the other side. We haven't hit either one of the ADRs yet at this point. We're more positive than negative, right? We're up more than 0.25%. So the baseline bet would be that we get to the upper edge before we get to the lower. I would take that off the table if we get underneath yesterday's close. Now, whether you mark the 4 o'clock close or the 5 o'clock close, now it may adjust a little bit one way or the other. I don't think it's going to, be too complicated no matter which one you pick. If you struggle with trying to decide which one you want, let your broker decide it for you. And what I mean by that is you can go to a daily chart and you can mark the daily close on that daily chart. That's what your broker has decided is the close. 58.8175. That's the close. And that way you don't have to make a decision about which close do you want to use, the 4 o'clock close, the 4:15, the 5 o'clock. It's whatever the broker used on its daily chart. I believe if we break below that level, and not just a wick down either, right? Not like one of these swing low patterns, but if we get a solid close below that level, it's very likely that the upper ADR is off the table until we get at least down to the lower ADR. We're still underneath the weekly pivot point. Today's channel is lower than yesterday's channel, but price opened above it. So being lower than yesterday's channel is a bearish check mark. Being opening above it is bullish. There is an issue with the idea that, generally speaking, markets hit their pivot point about 80% of the time. So we would have an 80% chance that we come down and hit this pivot point. To be fair, though, we had an 80% chance of hitting yesterday's pivot point and we didn't hit it. That's what we call an MDP, missed daily pivot. Now, I didn't develop the concept and the trading style for MDPs, and I personally don't trade them, but I do use them for analysis. If you want to learn more about what an MDP is, you can go to YouTube, Google, and just start searching for missed daily pivots. You'll find the guy that did kind of highlight that. I don't want to necessarily say he created the concept, but he sure did a lot of videos on it. You'll find it. And, you know, whether you use it for trading or just for analysis, it does provide insight. So we had one yesterday, and it doesn't count for yesterday. It counts for today. And so far today, we've got one which wouldn't count for today. We would use it tomorrow. Because until the day is done, we don't know that that's going to remain a missed daily pivot, right? We could hit it at any point. We almost hit that one yesterday before the day was done. On a continued move to the upside, 59.25 is the week's floor pivot, and that's going to be a level of interest that we've got to get through. We've got a lot of things overhead that are going to be an issue with getting through it. It's one of the reasons that I don't believe we'll have just a nice clean shot back to the upside. I think we're going to have to fight for it, tooth and nail, all the way back up. We got last week's point of control, 59.50. So the weekly floor pivot at 59.25 and then the point of control at 59.50. That's two quarterly levels that, you know, normally we use the quarters on the NASDAQ, not the ES, but this is bringing the quarters in on the ES. So nice round numbers, 5,900, 59.25, 59.50. We don't have a reason at this point to see 59.75 as an issue, but we'll keep an eye on it and see if we come up with anything that lines up with that quarter. I like it when we've got easy numbers to remember. Now you can see the profile from last week, and it doesn't really match, you know, like a normal distribution with a single D shape, and it's not a double distribution with two Ds, more of a 3D. I wouldn't lean too deep into that either. You know, the idea is that you either have your classic normal distribution or you don't. And if you don't, then just move on from there, that you just don't have it. Back here, for an example, was a very classic D shape, a very tight range, clear profile, center point of control, or the two Ds here. What we had last week doesn't really conform to any of that. And if there's just nothing there, then there's nothing there. The main thing is that there's a lot of trash. I don't really have a better word for it. There's just a lot of junk, a lot of trash overhead that we've got to work through. $10-day, 30-minute volume profile and TPO. They're both lined up at 59.50. It's the same point of control that we were looking at on the weekly, only this is for 10 days. And we're not expected to see that change anytime soon. When it does, it's very likely going to end up at 58.60 at this point. That's kind of the line that I've been looking at. The question is going to be whether that will end up below us or over our head. So 58.60, kind of the line that we want to stay above, since that's likely where the new point of control is going to be, but it's going to take a while. We've got to lose all of this volume from back here. And I don't think what we have here will be enough to be an issue. It's back here that we really got to focus on. While at the same time not holding in a particular spot somewhere else, so that that 58.60 area can really start to build out. It'd be this volume, which at the moment doesn't look like much. But as time goes on and we start to wear out, each new candle to the right is going to remove one from the left, and it's going to remove the volume with it. So we start working through this. We'll lose all of this, so we won't lose the channel size. And unless we make a new high, we're not going to lose this high anytime soon either. It's going to take a week and a half at least to see this profile shrink as we start taking out these candles. And that's if we haven't gone up there yet and made new highs by then. We have a new VPOC from yesterday. That's close enough. 58.30, basically. That just gets added to the list. Kind of zoom out here, you can see we've got a lot of them overhead to deal with. And we have one left, which really, it doesn't need to be there anymore. It's from the previous contract series. You know, the idea is keeping these points of control like it's unfinished business, and that if we go back there, there could be some trader's remorse. We're likely to see, you know, them make decisions again. It's where the greatest amount of trading took place in a particular time period. Well, that doesn't really hold true if it was in a previous contract that no longer exists, right? That's why I no longer carry those VPOCs forward if it's on a previous contract. It's hard to imagine there's unfinished business when those trades no longer exist. Having said that, though, I've seen a lot of analysts who will use gaps and, you know, previous highs on a, say, an equity in a stock from 10 years ago, 15 years ago, 20 years ago, where they'll mark out highs when, you know, we get a stock that's finally working its way back up to a high it hasn't seen in 20 years. And sure enough, that high from 20 years ago ends up being an area of interest, and we see a response. So, you know, just because it's a previous contract that doesn't exist doesn't necessarily mean that that level has no interest anymore. We got a really tight profile this morning. If we're looking for hurry up and wait, it would look a lot like this. We'd have a very tight very narrow initial balance with no real follow through in either direction. And even as we go through the Asian session into the Europe session, we still got no follow through. But we are inside day breakout. We've broke out of Monday's range. It's not quite a follow through day yet, because we've already started to fade back off of a key level 59.11 cog line. But we're holding that breakout. So it can develop, especially after 8:30 today. If yesterday was going to be a hurry up and wait day, we wouldn't have expanded and had a breakout higher than the Globex into the close. That's why I said it. So far, it's not forming up to be hurry up and wait on economic data. Not yet. If we start to chop after the 8:30 data, the range will be from our own Globex high to yesterday's low. Now, having said that, we can wick higher than our own high. We can even go a couple of candles higher, but we would expect to come back in again. That would be, say, the line in the sand at 100, and then you'd have the 111 and the 123 above our current Globex high, and then yesterday's low for the low side. $59.65 is the week's expected move high, and $57.57 is the week's expected move low. So far, we're nowhere near either one of those, which is par for the course because it's for the whole week, and we've only had a day and a half so far. We're still below the 10-week. That's not a surprise. But we are working our way back towards it, as we've done, in the past. A 2 or 3 bar move, what we call these swab bars. You get 2 or 3 of them, and generally you're back above again. There is a sustained example of a pullback that lasted a lot longer. So far, we're not in that yet. Right? As I started all of this morning, this pullback isn't as deep as what we've seen since we came out of the bear market and started moving back up in the last few years. We've had 11%, 9%, and we're not there. So looking at the 10-week, we're not oversold. We haven't moved too far, too fast to the downside, and it doesn't owe us any sort of mean reversion back to the upside. Looking at the 10-day, we've got plenty of examples of what oversold would look like, and I don't even like using that phrase to begin with, but if we had to use something that says we've traveled too far to the downside too fast, it's not showing up that we've done that. So sure, it was a decent move to the downside, but it was controlled selling, not just wild abandon. And we really haven't had that kind of capitulation sell-off yet. You'll know it when you see it, and we don't have it. And we can say yesterday, that was a nice recovery. We came back up. We closed at the high. Agreed. There's no argument against that. But if that was our capitulation low and flip, it was a pretty pathetic move. All things told, it wasn't very good. There's a million examples that would show a better version of that flip. So, it doesn't mean that we can't go up from here. We've got plenty of examples like this where we managed to flip, and then we just ground sideways for a while, kind of holding the line without getting any more negative, and we went up. Or here, right? So even though we don't have a classic perfect textbook capitulation low and flip, it doesn't mean that we can't turn around and go back up anyways. Because there's more than one way to turn around, right? Just the classic is kind of the fun one. It's the good one. It's the one that pays really fast. So for the 10-day, we're moving in the right direction back up. This is the third shot. We've already done it twice before. We'll see if third time's the charm. Counting it matters, right? There's plays like the 1, 2, 3 fail setup. Then there's also how we define trend with 2 lower highs and 2 lower lows, and that matches those swings and those attempts to get back above the 10. So tech is more negative than it was before, although it is trying to come back a little bit. That's a red day, but it's a hollow red day, showing that we rallied back up higher than where we opened, but we closed lower than the previous day's close, which is why it's red, but it's hollow. So we were down a lot more than 4.85 over a 5-day period, but we took a lot of it back in that rally. That is not healthy yet. That's not even close to being healthy. Now, having said that, on an LRE, it's cheaper risk-wise to get in before you have a signal to go long. If it's where you can risk the least amount of money, right? So that's why we call it a low risk entry, LRE. But your quote low risk isn't because it's a high probability trade. It's quote low risk because it's usually where the cheapest amount of risk can be used, right? Meaning basically you can use a smaller stop. It lines up with a lot of these reversals: industrials, building materials, healthcare, energy, consumer discretionary, financials, which are about to kick off earnings this week. So we got a lot of things that were at least trying to stabilize yesterday and close on the move up. Utilities didn't close on the move up, but it was the only one out of all of these. Maybe Staples, had just, I mean, that's basically a doji. So if we zoom in on it, it still counts. It closed up. But I think if it had just a little more time in the day, it wouldn't have. So if we're going to turn things around and start working our way back up, this money flow needs to concentrate back into the normal space: financials, consumer discretionary, technology, communications, chips. And then that rising tide would lift all the other boats. You don't want a market rally or recovery based on healthcare and energy. It's not sustainable. The VIX is still up 8% over a 5-day period. It's down this morning 2%. Nat gas is down. Basically, that's it on the things that are down. Looking at what's up, China stocks, more China stocks. Both of these two top names are China stocks. Then we got Bitcoin, more Bitcoin, and then China again. So the top 5 ETFs this morning is Bitcoin and China. 6, you want to bring in emerging markets, that's basically China too. So everything that's up more than 1% is China and Bitcoin. Now we get below that, we start getting into home builders, which takes us back to California and having to worry about yields and whether or not they're even going to be allowed to rebuild. Then we've got semiconductors and the Mag 7, semiconductors again, uranium, precious metals, gold miners. and we run out because our benchmark is 0.5%. So we've got some good stuff in there if we're looking at a risk on markets that are willing to take risk. Well, it doesn't get more risky than Bitcoin. It's a nice tell for aggressive or bullish exuberance is to see Bitcoin making moves to the upside. The problem with that argument is that Bitcoin was down more than 11 or 12%. And if a market drops 12% in 5 days, it's not a surprise that it's moving up on the 13th day or on the 6th day, right? Like a dead cat bounce, we're just popping up. So same thing with China. China was down more than 6%, and now it's up. That could also just be a dead cat bounce. We need to see more on both of those, but it's a good start on a reflection of risk. We need more out of the chip space. Wouldn't hurt to get more out of gold and precious metals, but chips being backed up by the Mag 7, that would be a rally that could stick. But we've still got a lot of economic data on the table for the week, and we need to watch through the day today to see if we start to go into that hurry up and wait mode, where we start to consolidate on the intraday and hold a tight range, and rejections fail and we don't see new adjustments in the call wall, the put wall, volatility trigger, zero gamma, none of that, right? And then the options flows start to surround it as they hedge out each side and we get closer to tomorrow's data point. Looking at what's up this morning on TrendSpider, China, Bitcoin, China again, uranium, emerging markets, that's China again, semiconductors, and tech. Gold miners. So IWM, we were talking about it at the start of this, small caps were up the most. IWM isn't at our benchmark yet. So maybe it's just giving some back. It's getting some flows though. Got my own little way to play small caps. So you've got the different kind of ETFs. And then you can look at IWM, the top 20 names in there using the weight that they have inside IWM. And we can see, you know, in after hours here or extended hours, which ones are doing good. But there's an ETF, CALF, C-A-L-F, and then COWS. Those are the top performing small caps and mid caps in their respective ETFs. Top 10 in the IPO space. So CART, but CART's been getting flows anyways on that run up in that digestion. But if we're looking at small caps, I'm not seeing the typical suspects. So that would make us think of maybe it's the GameStop crowd, right? The whole Reddit space, GameStop and Riot and all of those. You can check those instead, right? Those high short interest names rather than just a general perspective of the small cap space. Maybe I missed something, you know, like maybe Roaring Kitty was out on social media again. I'm not seeing it if he was, that's for sure. So yeah, Riot's up a little bit, but that ties in more with Bitcoin than anything else. So I wouldn't get too hung up on that small cap space move, it's very likely just connected to the headline that there was a lot of money flow coming into small caps compared to what there had been. You got to be careful with those kind of articles, right? And same thing with like Thinkorswim's Sizzle scan. Sizzle is a 5-day average, and whether or not we're above the 5-day average, and you can replace the last word with whatever you want. The 5-day average volume, the 5-day average volatility, right? The 5-day average call volume. So if you run a scan on Thinkorswim and you find things that are 10 times the 5-day average call volume, well, wow, that sounds fantastic. Then you go in and you look and you realize their average call volume is 100 a day, meaning basically no volume at all. And one trade came in with like, say, 600 calls, and wow, ta-da, suddenly they've got this massive sizzle. So if the IWF or small caps ETF inflows are significantly greater than they have been over whatever the article was talking about, 18 months, but it's been, a very marginal amount to begin with, then it doesn't take much to beat a marginal amount. And looking at the small caps that I track, they're not really getting the flows for that kind of small caps rally that we would be looking for, especially like a short covering rally connected with small caps. Not yet. We do got a good start on things that are moving this morning. We just need to keep the Mag 7 in focus with dollar and yields, and keep your eye on the news. You got the high and low of the day. It's the Globex high. Now, sure, we can get data at 8:30, and that can cause us to wick or even just straight up break out of the high that we've set today in the Globex. That's absolutely possible. But I wouldn't expect it to stick. And I'm not bearish. So while I'm saying the low of yesterday is the low for this range, I have no expectation that we're actually going to go down and tag that low or go lower than that low, unless the news this morning is really nasty. And as far as I know, we're not expecting the news to be that bad. So if we just use the Globex range that we have, there's your 111 and your 1236, 59.21 at most. We don't have a confirmed hurry up and wait yet. Will be confirmed that this is a hurry up and wait if we reject 59.21 or less, right? If we can reject the 111 just as easy. We reject that, we come back in and we stay inside of Monday's range into tomorrow, then we'll know. Otherwise, if we break out and we get through the 1236, then we'll focus on the half, or basically Friday's high, Friday's range. That's what I got for you guys. Watch the clock. Be careful, be safe. I'll see y'all tomorrow.